Good afternoon, Facebook friends. Hope you all are having an excellent Wednesday. Thank you so much for joining us. We are discussing today the lending market in Austin, Texas, and we have assembled an amazing panel of Austin mortgage experts who are going to speak for the next 45 minutes on all things lending in Austin. So let me introduce to you our wonderful panel has been so generous with their time today. First, we have Ken Ziegler, who is a loan officer with Capstar. Ken has had many successful careers leading up to this point in technology and in sales, operations management with global responsibilities for several multinational companies. He brings all that expertise to the lending market here in Austin. Also, we have Ryan Leahy with Leahy Lending in Security National. He has been a leader in Austin, in the Austin mortgage scene for, I think, 18 years now. So many of you might be familiar with him. And then also, we're fortunate to have Mark Smith, who is the Senior Loan Officer with Legacy Mutual Mortgage. Mark is newer to the Austin scene than maybe Ryan is, just being here for 5 years. However, he has been in lending for 25 years before bringing his talents to our market. So thank you all, gentlemen. Welcome. Thank you so much.
Thank you. Glad to be here.
Wonderful. We've got several questions that we've compiled, and actually these have been kind of discussed on other conversations I've had with clients, with colleagues, and in other forums. Just I think where a lot of confusion is resting in the minds of both realtors and their clients. And so we've kind of combined those and put this list together. And I'm just going to start off and go through just sending some of these questions to you all one by one. So I'd like to start with Ken, if that's okay. One of the questions that comes up so much, almost in every single conversation we have with our clients, is to clear up the public's confusion between when the Federal Reserve actually changes interest rates. We know like a week or so ago, there was a big announcement that they cut rates to zero, and have an explanation for the layperson on how that truly relates to mortgage rates and why mortgage rates aren't also zero.
That's a great question, and it's a common question. And anytime the Fed changes the federal funds rate, we get lots of questions, particularly people asking, "Hey, is the rate on my mortgage going to change?" I'll give a textbook answer for what the federal funds rate is and how it differs from the mortgage rate. But let me give some context first, because I think the technical answer, people hear it and then they forget it. So let me give some context, and I'll use a movie from American culture. If everybody could think to the time when you've watched the movie It's a Wonderful Life. Jimmy Stewart stars as George Bailey. And in the movie, they experience a run on the bank, the bank that's in town, Bedford Falls. And the run on the bank was started by a few things, but ultimately there's some fear, there's uncertainty and doubt, and people are going to the bank to get their money because they're afraid that if they're last in line, the bank's not going to have their money. And so with that as context, a couple of things have been put in place so that we in the United States do not anticipate, if you will, a run on the banks. So notably, the Fed's goal is to promote strength in the U.S. economy, and they've done a couple of things to do that. And so one of the things that is put in place today is that the Fed requires banks to maintain a certain amount of reserves. It's money that the bank has to keep in a vault or in deposit with the Federal Reserve. And so at the end of every day, and if anybody's ever had a job where you deal with lots of cash, you'll relate to this. At the end of every day, the Fed counts the amount of its deposits, and they come up with a number, and they by law have to then have a certain amount of reserves for those deposits. So if they got in, let's say $100 million, they can't lend out that entire 100 million. They have to keep some of that money on hand. But what happens to them at the end of the day, they realize they don't have enough money. And so what they do, they contact another bank that has some excess reserves, and they ask that bank to loan money to them overnight, so that when they open their doors at 9 o'clock tomorrow morning, they meet the reserve requirement that has been established by the Federal Reserve. This promotes, if you will, stability in the marketplace. It gives us peace of mind in knowing that if we wanted to go to the bank, or if we needed to stop and get some cash on our way to work, that the money's going to be there. And so the rate that one bank charges another to lend them that money overnight, it's called the federal funds rate. And that's the rate that the Federal Reserve changes. They set targets for that rate. And so literally, it's the rate that one bank charges another bank to loan it money overnight. And a thing that's super notable about this is the time period. Imagine an overnight loan is about the shortest amount of time that you could lend money to an entity, whereas a 30-year mortgage has almost 11,000 nights. And so mortgage rates, the federal funds rate can influence mortgage rates, but it does not directly, if you will, impact mortgage interest rates. Mortgage interest rates are affected by the price of mortgage-backed securities. But before getting into too many details, it's the key notable thing also is that the targeted rate that the Federal Reserve is going to have for its federal funds rate, it's largely predicted, and there are websites you can go to, and so mortgage-backed securities, they are typically anticipating what that rate is going to be and what change the Federal Reserve might make long before the action is ever taken. And so those are a couple of reasons why the mortgage rate, it's not directly tied to the federal funds rate, and it may or may not go in the same direction as what is happening with the federal funds rate.
Okay, thank you. That was very thorough and very clear. So thank you so much for that. Let me skip over to Ryan and ask him about loans. We are having some conversations with clients about conventional versus jumbo. Can you tell us which loans are being affected right now the most and how?
Yeah, no, that's also a great question and a lot of confusion in the marketplace. We have conventional loans right now. There is quite a bit of flexibility and money for the conventional loans in the market. The two loans that are really being affected the most right now has been the source of money for the jumbo loans, as well as government loans. So any VA, USDA, FHA, those loans are being hit the hardest from an interest rate perspective, as well as the credit score requirements are going up. The market as a whole over the last 4 weeks really took a pause on the large majority of jumbo lending for a large purpose because they just didn't have the cash reserves, is what it looks like. And also they just don't understand exactly how to measure some of the post-corona furlough of mortgages, is where they're pricing up some of the interest rates. So at our firm, we came with a solution to actually open up a line of credit for our jumbo lending to bridge the gap. Jumbo lending interest rates are being quoted in the high fours and for most of the market. And at any rate, we brought a solution in the high threes for that. So that's what we did in order to try to provide a solution to the marketplace.
So you mentioned jumbo loans. Those rates are going up actually, while conventional rates are going down. Is that accurate?
Conventional rates have been going down. They actually reached their lowest point about 6 weeks ago, and that was prior to the shutdown. It was actually prior to the stimulus package announcement. And it was prior to what we really understood to be the impact of the coronavirus on the mortgage market. And And so, but rates have gone up to in that 3.25 to kind of mid threes in the conventional marketplace, and are kind of hovering around there. As the Fed actually slows down its buying, there's an article that we found and have been sharing with our community about the unintended consequences of the Fed's buying. And what it did is they overbought in the mortgage market and actually decreased the values of the servicing rights. And it gets kind of technical, but to stay high level, interest rates did raise about anywhere from 3/8 to a half a point. And for that 30-year fixed mortgage borrower, they're kind of holding in the mid threes. But the jumbo interest rates skyrocketed, as well as did the government interest rates. And Wells Fargo on April 3rd suspended all the correspondent lending for jumbos. Caliber is one of the larger wholesale lenders in our space, suspended all of its jumbo purchasing. And there's just been a lot happening in the jumbo environment, and a lot of folks have really reduced their capacity there. And so we as a firm were able to bring a solution to that for this time.
Okay, all right. Hold that thought, because if we have enough time, I might ask you specifically about those solutions.
Yeah.
In more detail. But Mark, let me ask you, this is also a common question, and I'm sure you've probably been dealing with this as well with your clients. What are the similarities and the differences between today and the mortgage meltdown of 2008?
Well, actually, there are some, when the mortgage meltdown was occurring, there was a whole bunch of challenges that were kicking in. Number one, you had primarily you had a time frame where there was an oversupply of homes. These are the primary differences from what we saw then versus now. There was an oversupply of homes. Number one, there were markets where we were dealing with hyperinflation. I remember in Maricopa County, which is the part around Phoenix, they were dealing with year-over-year appreciation levels of around 50% in 2004 and 2005, and that's just not long-term naturally supportable. Right now, we're seeing, I think, normal inflation levels, depending on the market. High levels are, probably around 10. Normal levels are around 5, which is a much better number that is more long-term supportable and is going to result in less of a blow. Also in Texas, which is kind of a nice thing, you can't, because of the 50A6, the Texas home equity limitations that are out there on a homestead property, you can't really use your property as a piggy bank. And that's what, unfortunately, a lot of people were dealing with back during, prior to the meltdown. There were, you could do cash out refinances at crazy levels for loan to value, where people were pretty much stripping all the equity in their homes. And that oversupply, I mean, you were dealing with a 2 months, or I'm sorry, effectively an 8-month supply of homes then versus say around a 2-month supply now. So those are primarily differences. There's also, I think, a difference in the amount of equity that people had then versus now. People generally have actually more equity as a whole. The similarities are, I would actually equate this environment to being a kind of a combination of 9/11 and the mortgage meltdown at the same time, because you have the economic event of the mortgage meltdown with, these recessionary pressures, people losing jobs and people getting furloughed and so on. But then you also have kind of a fear mentality that's kicking in, where people simply either can't or don't want to go outside. And that actually happened during 9/11. I mean, literally the world kind of shut down because people were literally glued to their TV screens for almost a month straight. And that kind of created a mini recession, which then the market completely rebounded on. We saw a wonderful expansion in the housing and mortgage markets that unfortunately then led up to the mortgage meltdown because there was actually too much of an expansion. So that's pretty much it. I mean, very, very similar, but also very, very different in terms of how it's happening. And then probably the biggest thing is literally speed. What took the mortgage meltdown roughly about a year to bake in terms of overlays and changes in credit policy and so on, unfortunately, in our world today has taken weeks. and sometimes less than that. The pullback that we saw in the jumbo financing, pullback that we saw in the government financing space, that didn't happen over the space of a year. That happened over the space of about five to 7 days. And that's a severe change. So I think it's overreaction in a lot of parts, but I also think that there are some valid issues that they're dealing with, namely from a liquidity and capacity standpoint. So that's it.
Interesting. Okay, good information. Ken, what would you say to buyers that are trying to make their decision if they should purchase now or wait up to 6 months or longer? What kind of advice are you giving them?
So for buyers, I would say it is a great time to buy. So if you can get qualified and you can meet, sometimes a little bit more strict lending guidelines, but if you can qualify, it is a great time to buy because there is less competition. Less people are qualifying today than what they were 3 weeks ago. And so if the house you were looking for, if it's available and you love it, there's going to be less competition for you. You might be able to negotiate a little bit better price than you would have if there were multiple offers on the home. So if you can qualify and the house you like is on the market, move full steam ahead.
Well, what I remember from being in business after 9/11 and after 2008 is there are always buyers who want to buy and there are always sellers who want to sell, no matter what's happening in the market. I remember
Absolutely.
being busy right after 2008, initially for those buyers and sellers who had to buy or sell. Either they were moving, some of them did have some financial difficulties and they needed to kind of, hedge their bets that they weren't going to have further problems down the road. So I think it is, and I appreciate you all being here today because I think it is a service to be able to provide accurate information to the public because there is a need either way for buyers or sellers. So I do agree with you on that. Mark, can we talk a little bit about rates? And right now, I feel like some people feel like things are very volatile. What are you seeing, and when do you think things might stabilize?
Well, I think they've stabilized for the most part.
Okay.
What we experienced during the last 30 days or so was just some wild and crazy volatility that was tied to a combination of liquidity and capacity. You had a bunch of investors and lenders that literally were being asked to, they'd already been asked to eat 28 different plates of spaghetti. And now with all the refinances and everything else that was still coming down the pipe because rates had plummeted down so low, that they were now being asked to eat another 28 plates of spaghetti. And just simply there was a capacity issue. Literally they can't originate and take on that many loans without exploding the system. So the best way to be able to control capacity other than hire people, which is generally a bad idea when you're kind of worried about whether or not you're going to have to lay them off, is just simply ratchet up rates so that you can throttle that demand back a little bit. Because simply if your rate is 3.5 and everyone else is at 3.25, you're probably not going to be getting the loans that the 3.25 people are going to be offering. Okay, so that was the big issue having to do with capacity. But then there was also the liquidity squeeze. This is actually what has popped up in the jumbo and the FHA and government space. Literally, there's kind of a liquidity problem. This is partly because of the way servicing values are managed and how servicing is handled in the government insured space compared to conventional and Fannie Mae and Freddie Mac. If it's a conventional loan, those loans are generally sold to an investor based off an accounting method called actual. That means that you as the borrower, if you pay me as the servicer, I send that money to the investor. I'm servicing the loan on behalf of the investor. You give me the money and then I give it to the investor. And if you keep doing that, that's what happens. But then if you stop paying me the money, then I don't have to front that money to the investor. Unfortunately, in the government space, those loans have to be sold under what's called schedule. And what that means in that case is that you as the borrower, you pay me as the servicer, and I give that money to the investor, and you keep doing that. But if you stop paying me, I actually still have to front the money to the investor. So, and that has created a massive pullback in the government space simply because you have all these servicers, typically the non-bank servicers, and there are a lot of them and they're big, who are having to write billion-dollar checks every week to deal with the payments that they have to front to the investor that they're actually not receiving from the borrowers because they've been furloughed or laid off, or simply their job income has terminated. And that's also impacted, of course, the government lending, the jumbo lending, because that is raw portfolio lending for the most part. There really isn't a true secondary market for those loans. So every lender that's doing jumbo loans is really lending out their own money. Well, if they're having to front all this money, for these other loans that they're not receiving payments for, that's going to start increasing the interest rates. So we started seeing this wild gyration. Rates would drop, probably 0.25%, and then they'd climb 0.75% in the same day. And we were seeing that over and over and over again. And it was simply because, and it got to the point where you had investors, because the stock market was tanking so heavily and so quickly. You had investors, institutional and otherwise, that were simply, normally what you do is you take your money out of the stock market and put it in the bond market, which is what supports mortgage lending. Well, in this case, we're actually seeing people literally pull their money out of the market altogether and just simply park it on the sidelines. So that meant that the stock market was plummeting. The bond market was plummeting from a price standpoint, which was driving prices up. And so the Federal Reserve decided to step in and say, look, we've got to create a backstop. We need to create a supply, or rather a demand, of mortgage-backed security money to keep, funding the mortgage market the way it is. And when they jumped into the market, they were like a giant gorilla jumping into a pool, and just created a whole bunch of waves and a lot of uncertainty. And then the waves subsided. Now everyone is just acknowledges the fact that there's now a gorilla that's doing laps in the pool. So as a result, there's now a lot more stability. Rates, if you look at where they have been over the course of the last 2.5 weeks since the Federal Reserve started buying all the mortgage-backed securities, they've really evened out a lot. I mean, they're still going up and down and up and down, but they're not dealing with the wild gyrations that they would normally deal with. So I suspect that as the market improves, and as the stock market and the overall economic environment improves, the Federal Reserve is not going to have to act as much of a backstop as they are right now. But while they are acting as a backstop, they're going to be doing essentially the same thing that they did during 2012 and 2013. And between September of 2012 and July of 2013, we saw interest rates just kind of hit this floor of roughly about 3.25, 3.375. And they kind of stayed there for roughly about 9 months. And I kind of expect the same thing to probably happen now. We'll see them jitter up a little bit, a little down, stay the same, but we're not going to be seeing the wild craziness that we saw before, namely because the Federal Reserve has created that stability now.
Excellent. Thank you. Thank you for that. Ryan, you and I have spoken recently about portfolio lending. Can you share with the audience exactly what that is and how it comes into play in the market?
Absolutely. So portfolio lending, as Mark just alluded to, the jumbo lending is lending your own money. And so we work with several different investors that do portfolio lending, everything from there is almost a stated income loan. It's a 1-month bank statement loan with 25% down, to different nuances that people have. Our specialty in the portfolio lending space is on the jumbo side. What we did in particular, though, so our parent company is a life insurance company, and this goes to also expanding on what Mark said, is that as liquidity crunch has been in the marketplace, and investors and mortgage companies have had to write millions and millions and millions of dollars of checks every week to cover the locks, the locked interest rates that are in the pipeline, they pulled back on a lot of slowing the volume down. And so because and you can only keep so much cash on the sideline in reserves, because nobody really anticipates a event like the coronavirus coming into the mortgage business, and what does that look like? And so what we were able to do, our company, our parent company is a life insurance company, and so we were able to tap into those reserves and create our own portfolio line on those reserves that we service. And so we came after it from a standpoint of, we're going to be here to bring a solution to the marketplace, when right now there's a window where that just the investors are still trying to recapitalize, the lenders are trying to recapitalize from their margin calls, And so that's what we have done. And so we've been able to bring for ARMs up to $1.5 million in the low threes for a 5.5 arm, and then 30-year fix is in the high threes. And so those are, we haven't seen any of our competitors be able to do that yet. So it was a strategic move by our firm to really try to go after market share. And so that's what we.
So is that what you were alluding to earlier when you talked about solutions for jumbo?
Yes.
Okay. So if people are hearing in the marketplace that the jumbo opportunities are limited, portfolio lending is something that they should be looking for, perhaps, as a solution. Fair to say?
Each one between Ken, Mark, and I, each one of our firms offers different solutions, and this was our firm's take on how to bring solutions to the marketplace. Portfolio lending generally is going to be your more niche lending. So whether if it's for a self-employed borrower or not 2 years tax returns, those types of things. But ultimately, in this case, also the portfolio lending that we brought to the table in this case is our own portfolio jumbo product to meet the market where a spot that it needs to be filled. And we don't know how long is it going to be before the market returns to acceptable interest rates on the jumbo side.
Right.
And so we are there to be that solution to the marketplace.
Okay, thank you. Ken, we had a discussion just yesterday on forbearance. And I think that you had a couple points that I think would be valuable to share with the audience. Can you speak to us just a little bit about that?
Yeah, thanks very much. This is a hot topic right now. So forbearance, as part of the CARES Act that was passed in March by Congress and signed by President Trump, for individuals who are facing economic challenges as a result of COVID-19, i.e. job loss, job furlough, et cetera, or being sick, actually, right? So for those individuals, the government stated that those individuals could go into forbearance, which means they can not pay their mortgage. And by not paying it, they wouldn't be penalized by having a foreclosure proceeding advance against them. They also would not be affected negatively through a negative impact on their credit report. Okay, the banks cannot report that the person is late on paying their mortgage. And so this was announced, and shortly after it was announced, the servicing banks were inundated with phone calls about this. And a key thing that I would say about forbearance, and this is super, super, super important, if you need to go into forbearance on your mortgage loan, then know that it is there for you, and there's no shame in doing it. The trick or the risk, I will say, is there are many people who don't need to and are not understanding yet what some unintended consequences are. As an example, when you come out of forbearance, the way it's set up right now with most servicers, and each consumer would need to speak with their servicer directly to understand what that servicer has in place. But typically, when you come out of forbearance, every payment that you skip has to be made immediately. In some cases, they're saying, okay, you can pay this sum back over a certain time period, but there's an expectation that the money is going to be paid back rather quickly. And I think a lot of people don't understand that. And so I would say for people who are considering forbearance, talk with your servicer, get all the facts and details that you can.
Right.
If you have savings and you can continue to make your payments, forbearance may not be the best choice for you. If you have a 401k and can tap into a 401k loan, forbearance may not be the best thing for you. I'll leave it at that. There are some unintended consequences that are also affecting the banks, but I won't go into that detail for this audience.
Okay, that's
Can
good
I add
advice.
something to that?
Sure, absolutely, please.
So there's another challenge that we are also seeing with forbearances as a whole, which is people who may have more than one home and they're looking at wanting to capitalize on where the rates are today. Well, if you're in a forbearance or if you started a forbearance, you're essentially telling people, look, I can't pay. I need help. Whether it's real or not, perceived or not, that's essentially what you're saying is, hey, I can't pay this the way you're telling me to. I need help. And that's what the CARE Act was kind of designed for. But that also means that, if you've got a lender who's looking at trying to put together a loan for that same individual, that individual is telling one group, hey, I can't pay. But then the other group, which is the lender who's trying to do the refinance, they're saying, I'm fine. Well, pretty much all lenders have taken the approach that, look, if you're in a forbearance right now, we can't help you from a refinance standpoint.
That's correct.
So it's super important that when people are looking at doing the forbearance, that they're looking at the real reasons as to why they're doing it. Are they doing it simply because they want to or because they have to? Big difference. Just because you can do a thing does not mean you should do a thing. So,
Okay, good. Thank you for adding that. That's good advice. And Mark, since we're on you, what, we've heard some concerns from buyers, well, and sellers too, that, how is the process going to continue if we are in a lockdown? How do we get the home appraised? Or things like inspectors, which obviously is not your lane. But can you speak to an appraiser? How are they going out and actually being able to do their jobs right now?
Well, so the various agencies have provided guidance, whether it's Fannie Mae, Freddie Mac, FHA, VA, they provide guidance to kind of alleviate some of the immediate pressures of, having to literally go into every single home and do that internal and external inspection on the home. In many cases, we can get away with property inspection waivers, which is where there's enough data that is in the various database portals that exist to where essentially if you say that the sales price in this and the borrower is borrowing 90% or less of that sales price, that we actually don't even need an appraisal in some cases. Or we can get away with an external or an exterior inspection of the property. There are unfortunately just some transactions where simply you got to do an inspection of the house. And the appraisers know this, and what they're pretty much doing with today's technology, they got to measure it, but they have the ability to be able to use the laser measuring tools that enable them to just simply stand in the middle of the room and not have to, really invade the home any more than they have to. From a lending standpoint, though, we understand that there's going to be some slowdowns everywhere. Title companies are overloaded simply because of the level of refinance volume and that's going on. Appraisers are overloaded because of the same thing. Inspectors are overloaded. Loan officers and processors. I mean, everyone on this panel can probably say that they've probably been a little bit busier, the last couple of months than they were, back in January and February. Everything is just probably going to slow down a little bit. So the reality is that lending isn't going to stop, but there are going to be some changes and some adaptations that have to be made. A lot of investors have to make sure that a borrower is actually employed and that there isn't a change in their financial situation that has occurred. So we're the documentation standard that we're used to of having documents that are dated within 120 days of closing. That's tightening up. We're now seeing documents that need to be dated within 30 or even 15 days of closing, and as well as verbal verifications of employment the day of closing to verify that someone hasn't lost their job the day of. So really, mortgage lending hasn't changed, but it's adapting, and it's adapting quickly. And pretty much every customer who's looking at buying a home, they just need to understand that they're going to be providing a little bit more documentation than typical. They're going to be providing more recent documentation than typical. And the reality is that 20-day closing that everyone used to be able to do and be able to commit to, they may not be able to anymore simply because of third parties that we literally cannot control their time frame. If it's going to take 20 days to do an appraisal, and you've got a 20-day time frame, obviously you can see how the math isn't going to work on that. So I'm simply recommending for most people, look, if you don't need to close in 30 days, let's not stress the system any more than we have to, because the system with everyone, having to work from home and now having to wear a mask when they go outside, good golly, everyone's stressed out. Why do we need to stress out the systems as well?
Ryan, I see you shaking your head a lot. Has that been your experience as well?
It has.
Any other like timeline constraints or anything that you want to add to that?
Yeah, I think Mark did hit the nail on the head. You know, I'm sure all three of us prioritize our purchases over our refinances. But we are always bound to what are the third party servicing that what are their timeframes, and so there are definitely some challenges there as far as meeting at less than 30-day close times. So yeah.
Interesting. You mentioned refis. We know we're talking about just conventional and jumbo loans. Are you seeing anything else? Cash out equities? Are you seeing any changes?
Changes. So the biggest, you mean as far as how consumers are, what kind of loans they're requesting, or?
Yes. Yeah. How you're interfacing with your new prospects, your existing clients, anything else? We know everybody's been refining just, nonstop for the past few months. Has there been anything that's changed in the last 30 days?
Absolutely, Jeanette, and that's a really good question, because so here's what we know is we put together and did some research on how have the past recessions affected Austin real estate. And here's what we know. You look at it, and it's a trend line up all the way. We went back all the way to 1990. And there are some obviously some dips that are going to happen, and so what we're doing is we're positioning all the large majority of our clients that have equity. We're positioning them with access to the equity. So we're usually recommending a refinance on the first, and then getting a home equity line of credit as a second lien. And our philosophy is, look, let's just prepare yourself to have runway for if something negative happens and you are affected by the coronavirus, you have some cash runway, some access to that capital, but really also for opportunity.
Right.
There's going to be a significant amount of opportunity that will come up over the next 6 to 12 months, or 4 to 8 months. When these furlough mortgages, people apply for them, and now they have to cough up a lump sum check for 4 months of payments. And they may not qualify for a mortgage modification. And
Right.
so there's going to be some significant opportunity that we believe is going to be available for our borrowers. And so that is something that we have been working with a large majority of our borrowers on, how we go about helping them position themselves for what we feel is going to be a great opportunity for most people to expand their net worth and their real estate portfolio in the very short months.
Yeah, I'm already getting those calls because, you gentlemen and those of us in the real estate community who position ourselves as consultants, we really want to kind of earn our seat at the table alongside the financial planners and the stockbrokers in creating a whole financial picture for our clients. We know that real estate is always a huge part of people's net worth, and we need to be in those conversations. So we've got just a few minutes, 6 minutes left. So if each of you could grab, and I'll start with Ken, just 2 minutes or so apiece, and talk to us. We don't have a crystal ball, but what would be your predictions for the next 60 days in terms of lending?
For the next 60 days, I think initially we're going to see a continuation of tighter lending requirements or guidelines. I think that once we begin to lift some of the stay-at-home orders and people return to work, I think that well, let me say it this way. Right now, there's risk. The banks don't know how many people are going to go into forbearance. They don't know how many people are going to go into foreclosure. And we don't know what the unemployment rate is going to reach. It could very easily reach, and it'll probably hit 20%, perhaps higher. And so that's risk. That's the unknown right now. Once we get ahead of that, and it's probably around 60 to 90 to 120 days out, once we start getting ahead of that, then I think we're going to see an explosive market. I do think, though, in the next 60 days, I think it's going to be muted. And I think it's going to be muted simply because of just the uncertainty of how we come out of the stay at home and to what degrees we begin to come out of it.
Thank you. Ryan?
I think Ken hit the nail on the head. It does have a lot to do with uncertainty right now. But with that uncertainty comes opportunity. And we do believe that, like Ken mentioned too, that all the technical factors that we see, particularly for Austin real estate, will be an explosive market on the back end of this. We are underwritten as a city by one of the top four wealthiest companies in the world, being Google, Facebook, Amazon, Apple. And so I was speaking with the head recruiters at Google the other day, and her exact words is Google is, quote unquote, basically doubling its hiring workforce so they had almost 2,800 people that they were expected to hire this year, and the exact verbiage that she used was basically double. And so that's for the Austin market. So that's really encouraging that you see a major employer like that doubling down in a space that when a lot of employers are laying off. And so, so there's going to be an opportunity for us to, for the people that are looking to buy, and Ken said this earlier, to really capture a good opportunity in the marketplace with possibly some sellers that, are more desperate than others. And so I think we're going to see a small buyer's market window that we haven't seen in a while, and I'm pretty excited about it. So,
thank you for that, Mark. I'll let you finish the last 2 minutes.
I would agree. I think the buyer's market is good for us. A seller's market is great on the real estate side. So I think we're going to see that buyer's market, but before that, we're going to have to deal with the pullbacks that are just going to happen. Again, I alluded to the fact that this is very similar to what we saw back during the mortgage meltdown. We're going to see tightening credit standards. We're going to see, lenders exiting the market just like we did, 10 years ago. And that's going to continue. But the key is going to be to what degree we're going to see the exact same type of pullback mechanisms that we saw then, only they're just going to be much more compressed until we can get back out of the stay-at-home component and start seeing what the true impact on the market is going to be. And then you'll start seeing that buyer's market kick back in. It's not going to be a V-shaped recovery. I think it's going to be more of a U. It's going to take a little bit longer, but boy, when it starts recovering, it's gonna shoot out of the gate like a racehorse, and it'll be kind of exciting to watch. So,
and we will all be there. We will be there, and we will be ready.
Yep.
Front row seats.
Absolutely.
Thank you all so much. Did somebody need to say something?
Yeah, can I add to that real quick? And Jeanette, one of the things I'd like to share if anybody wants to email you or get in touch with you, I'm happy to share. One of the things that Mark mentioned is that uncertainty piece. And I'm happy to share the articles on how the Austin real estate market has been impacted by the past recessions and what the effects were of it, and what the outcome was on the other side. And so if they want to get in touch with you, I'm happy to share that article and that research that we've put together, so they can see that this is a more opportunistic time if people have the capacity to do that. So.
Absolutely. Actually, what we're going to do, we're going to go back into the Facebook feed, and I'm going to put the contact information for you, Ryan, Mark, and Ken. So anybody watching this right now or down the road will be able to reach out to any of you. I want to thank you. I appreciate your time. I know it's crazy busy. It's just a different kind of busy. And so any hour that you can take away from that is greatly appreciated by me. So thank you all, Ken Ziegler, Ryan Leahy, Mark Smith, all leaders in the mortgage business in Austin, Texas. Reach out to them if you have any needs to refinance, purchase, cash out equities, anything that we discussed, or any clarity on anything we discussed. These are the gentlemen who can help you with that. So thank you all. Go out and have a prosperous and productive day.
Great. Thanks, Jeanette.
Thanks very much, Jeanette.
Bye-bye.
Thank you, Ryan and Mark.
All right. Thank you, guys.
Ken and Mark. Yep.
Bye.